Imagine you're the director of a major investment fund with $1 billion under management. It's 2026. Digital assets are no longer the Wild West. They're the real infrastructure of the global financial system. And you face a question. Which crypto protocol do you trust with corporate money? Bitcoin? Ethereum? No. Today, the most honest answer sounds different. XRP, HBAR, or XLM. 3 projects. 3 completely different approaches. But one shared goal. To become the infrastructure layer for trillions of dollars of institutional money that is entering crypto right now. In this episode, we won't be guessing. We'll break down real data, real partnerships, and real money already moving through these networks. Because when it comes to the institutional crypto stack of the future, facts matter more than hype. Before we dive into each project, let's understand why now. Why are institutions paying this much attention to crypto at this exact moment? If you follow the markets, 2025 and 2026 are a turning point. SWIFT, the system that governs international bank transfers, has officially set a deadline. November 2026. After that date, any payment that doesn't comply with the ISO 20022 standard will be automatically rejected. That means literally every bank in the world must migrate to the new financial data protocol. And here's the thing. XRP, HBAR, and XLM are all 3 compatible with that standard. That's not coincidence. That's strategy. At the same time, another quiet revolution is happening: real-world asset tokenization. Real estate, bonds, stocks, gold, treasury bills, all of it is moving onto blockchain. And to service these assets, you need reliable, regulated, lightning-fast infrastructure. The old SWIFT rails aren't built for this. They cost between $26 and $50 per transfer and require 36 to 96 hours to settle. In a world of tokenized assets where transactions need to happen in seconds, that's the Stone Age. According to a joint survey by Coinbase and Ernst Young conducted in January 2026 among 351 institutional investors, 73% plan to increase their digital asset exposure this year, and 74% expect crypto prices to rise over the next 12 months. 96% of these investors manage more than $1 billion. These are not retail speculators. This is real money. It's already standing at the gates and looking for the right infrastructure to walk through. Let's start with XRP, arguably the most well-known player in our trio. Ripple was founded in 2012. Over 14 years, the company survived an endless, exhausting battle with the American regulator, the SEC. That battle is officially over. And it was a critical moment because regulatory uncertainty was precisely what prevented banks and funds from openly working with XRP for years. Now that page is turned, and the results are already visible. According to the Coinbase and EY survey, 18% of the 351 major institutional investors already hold XRP in their portfolios, and another 25% plan to add it before the end of 2026. Add those numbers together, nearly every other major investor is either already in XRP or standing at the threshold. You'll agree that sounds different from speculative asset. But let's break down the technology. Why XRP Ledger specifically? Speed. A transaction on XRPL takes 3 to 5 seconds, costs literally fractions of a cent. And remember those SWIFT numbers, $26 to $50 and up to 96 hours of waiting? The difference is so obvious, it's hard to ignore. It's like comparing a telegraph to a messaging app. Now tokenization. This is where it gets truly exciting. By early 2026, the XRP ledger already holds $2.3 billion in tokenized real-world assets. That's up from $991 million at the start of the year, nearly doubling in just a few months. Looking at 2025 as a whole, growth was 200%. Yes, you heard that right. From $24.7 million in January 2025 to $567.9 million by year-end. 2,200%. Archax, a regulated digital securities exchange from the United Kingdom, committed to bringing $1 billion in tokenized assets onto XRPL by mid-2026. This is not a press release. It's a legally binding commitment from a regulated institution. Ondo Finance, Guggenheim, and Open Eden have already placed around $300 million in tokenized U.S. Treasury bills directly on the XRP network. The money is already working. Not planning to work, working right now. A separate conversation, RLUSD. Ripple's own stablecoin crossed the $1 billion market cap milestone in November 2025, in less than 1 year of existence. Important to understand, RLUSD was not built for retail trading. It was built as an instrument for banks, custodians, and large trading companies. Its financial infrastructure packaged in the form of a stablecoin. Binance added RLUSD for spot trading, giving Ripple global reach and opening a path to competing with USDT and USDC at the institutional settlement level. At the time of recording, XRP is trading between $1.28 and $1.33. That sounds modest if you only look at the price. But this isn't a story about today's price. It's a story about how many trillions of dollars could flow through this network over the next 5 years. All right. XRP, well known, widely discussed. But now let's talk about a project that moves quietly, almost without noise. And for exactly that reason, it's especially interesting. Hedera Hashgraph, token HBAR. If you haven't heard of Hedera, or only heard it in passing, this is your chance to catch up. Because what's happening with this project is hard to overstate. Let's start with the most unusual thing. Hedera is governed by a council that as of early 2026 has approximately 31 members. Maximum capacity 39. And among those members, Google, IBM, Dell, Deutsche Telekom, LG Electronics, Standard Bank, DBS Bank, Chainlink Labs, Ubisoft. Among the recent additions, Repsol and FedEx, which joined in February 2026. Do you understand what that means? This is not a crypto project with advisors on the website. This is a corporate consortium of global leaders who literally govern the network at a board level. Every member is a multi-billion-dollar company with real incentives to prevent failures or abuses. No other public blockchain has this level of corporate trust. Now the technology. Hedera doesn't use a classic blockchain. It uses a directed acyclic graph. This architecture allows the network to process more than 10 zero transactions per second. And the network is carbon neutral, even carbon negative. For ESG-focused institutional investors, that's not just a nice phrase. It's a real competitive advantage amid ongoing environmental debates around Bitcoin. BlackRock, the world's largest asset manager with more than $10 trillion under management, expressed interest in the Hedera ecosystem, specifically for tokenized fund infrastructure. When names like that appear next to a project, the market starts to reconsider its valuations. The partnership with Verra, the world's largest carbon credit standards organization, involves digitizing more than 20 carbon credit methodologies. Hedera is becoming the first major blockchain infrastructure for this market, estimated at tens of billions of dollars. Corporations buying carbon offsets from oil giants to airlines are now doing it through Hedera. Dubai is tokenizing land registry records on Hedera. Georgia is exploring using Hedera for its real estate market. When governments choose a blockchain for national registries, that's no longer an experiment. That's deployment at the level of national infrastructure. And here's another very important signal, the ETF. Canary Capital launched a spot HBAR ETF on the NASDAQ. Initial inflows reached $93 million. For an asset that most retail investors still don't know by name, that's a massive institutional signal. Money is finding this project. Quietly, without hype, through regulated instruments, yet HBAR is currently trading at just 8 to 9 cents. After all of these developments, do you see the gap between the fundamental data and the current price? That's what people call a quiet opportunity. While retail investors are chasing meme coins, institutions are methodically accumulating HBAR. Now let's move to the third member of our trio, Stellar Lumens, or XLM. And arguably, this is the most undervalued project among the three. Why? Because Stellar is solving a problem no one else is tackling head-on, connecting crypto infrastructure and the traditional financial system at the most fundamental protocol level. Let's start with ISO 20022. You remember, SWIFT set a November 2026 deadline. XLM is natively compatible with this standard. That means no additional integration needed, no translation layer. Stellar simply speaks the language of banks originally, by design. In January 2026, Stellar Development Foundation CEO Danelle Dixon published a detailed plan for integrating the blockchain with SWIFT infrastructure. The essence of the proposal: SWRT-LM becomes the settlement layer between traditional payment networks and open blockchain infrastructure. Picture the scheme. Banks continue working in their familiar systems and interfaces, but under the hood, settlements run through Stellar, instantly and for almost nothing. This is an invisible revolution, the most effective kind, because it doesn't require anyone to change their habits. Another landmark moment, DTCC, the Depository Trust and Clearing Corporation of the United States, through which trillions of dollars in securities settlements flow every single day, designated XLM as a settlement token. DTCC is the backbone of the American financial system. If they're looking at XLM as a settlement instrument, it tells you what serious conversations are happening behind closed doors. Technologically, Stellar isn't standing still. The Soroban smart contract platform launched with the Protocol 20 upgrade was built specifically for financial applications. Unlike Ethereum, Soroban includes built-in support for regulatory requirements and compliance directly at the smart contract level. For institutions that can't operate in a wild smart contract environment without clear rules, that's a critical differentiator. This blockchain treats regulators as partners, not obstacles. XLM is currently trading around 15 to 16 cents. RSI at 38 to 39, technically oversold. That's what technical analysts typically call an accumulation zone before a move. Now we've looked at all three. The key question: how do they compare? And here it's important to understand one fundamental thing. This is not a classic who wins battle. These are three specializations for one enormous market. XRP is the story of corporate payments and asset tokenization. The strongest RWA positioning, the fastest growing stablecoin in the institutional segment, and the largest base of professional investors among the three. HBAR is the story of high-performance corporate infrastructure and trusted governance. When you need 10, 0+ transactions per second, carbon neutrality, and the authority of global corporations like Google and IBM Hedera is the obvious choice. XLM is the story of seamless integration with the traditional financial system. Stellar is the bridge between the old and new financial world. ISO 20022 compatibility, DTCC recognition, and a SWIFT integration plan, these are not coincidences. They are the result of years of strategic work. Put simply, XRP is next. Generation bank transactions. HBAR is the corporate operational backend, and XLM is the global payment connector between eras. And here is the most interesting part. Ask yourself, what if this isn't competition at all? What if these three projects aren't three different answers but three parts of one architectural solution? Imagine the infrastructure stack. A payment is initiated in the old banking network through Stellar's ISO 20022 compatible infrastructure. Settlement happens through XRP Ledger in 3 to 5 seconds. In corporate data, smart contracts and registries operate on Hedera with trusted governance from Google, IBM, and Deutsche Telekom. Every element doing what it does best. This isn't fiction or marketing fantasy. This is the logic of modular financial infrastructure design, exactly how major banks think when building enterprise systems. Not one blockchain to rule them all, but the right tool for the right job. What helps this scenario materialize? First, regulatory clarity. The Clarity Act in the US establishes clear rules for digital assets. 65% of surveyed institutions explicitly named regulatory clarity as the primary factor for increasing crypto investment. Once that law passes, expect a flood of real institutional money that's currently sitting in wait mode. Second, the timeline. SWIFT's November 2026 ISO 20022 deadline is not someday. It's a few months away. Banks are adapting right now. And in this exact moment, infrastructure decisions are being made that will define the next 10 to 15 years. Those who choose the rails now will become the standard for a decade. Here's the practical takeaway for you as an investor. XRP, HBAR, and XLM are not speculative assets in the classic sense. They are bets on a specific structural thesis that the financial system of the future will run on blockchain infrastructure. If you believe in that thesis, all three of these assets deserve serious consideration. The risks are real and worth stating clearly. XRP is trading between 1.28 and 1.33, and despite strong fundamentals, the market remains cautious until the Clarity Act passes. 65% of institutions honestly say real money comes after regulatory clarity, not before. That means part of the potential is currently frozen, waiting for a legislative trigger. HBAR at 8 to 9 cents looks like an asset with a large gap between real fundamentals and market valuation. The spot ETF on NASDAQ with initial inflows of $93 million is the first major institutional bridge to HBAR. But lower liquidity means higher volatility in both directions. XLM at 15 to 16 cents is technically oversold. Fundamentally, it's one of the few assets with direct, native compatibility with both SWIFT and DTCC simultaneously. If the November deadline becomes a catalyst, XLM will be in the right place at the right time. The main thing to remember, diversification across these three assets isn't just buying three coins. It's a deliberate, structured bet on three different aspects of the same financial revolution: XRP speed and settlement, HBAR corporate infrastructure, XLM integration with the traditional system. We are living in a moment when the financial system is genuinely changing. Not preparing to change, actually changing. ISO 20022, real-world asset tokenization, institutional ETFs, regulatory clarity. All of this is happening right now, in 2026, not in theory and practice. XRP the power and speed, the trust of banks, and $2.3 billion in tokenized assets already living on the blockchain. HBAR the corporate elite under one roof. From Google to FedEx, 0 transactions per second, and quiet accumulation by the smartest money in the market. XLM compatibility with the old world, DTCC, SWIFT, and a native ISO 20022 connector that makes Stellar an invisible but indispensable element of the new architecture. 3 projects, 3 very different paths to one destination. And while retail investors are staring at charts and hunting for the next 100x meme coin, institutional money is quietly building the new financial world, methodically. With clear direction, contracts are signed, money has entered, standards are being set right now. The question isn't whether this revolution will happen, it's already happening. The only question is, will you be on the right side of this transition? If you found this episode valuable, hit the like button and subscribe to the channel. There's much more detailed analysis coming for each of these projects individually with price scenarios, technical analysis, and full tokenomics breakdowns. See you next time.